Well, happy weekend to you. This is The Real Money Pros, a live financial program here for you to answer your questions. You can call us. You can send us a text message. Phone lines are open and are at your service. That number is 979-59-MONEY, 979-596-6639. Any topics that you have top of mind, you want us to touch on it, it's all fair game. You want to talk about estate planning, you want to talk about tax planning, you want to talk about business exit strategies, you want to talk about highly appreciated, highly concentrated stock that you have no idea how to unwind because you're worried about the federal tax, the state income tax, the capital gains tax, the IRMA charge, which is tied to your Medicare Part B premiums, and then the net investment income tax. It's like, geesh. There are strategies and ways that you can get around it, or at least have a better understanding of how these things would actually function for your situation. So you're just not stuck in this position where like you don't know, so then you're not making a decision. And a lot of times you're not making a decision, at least in my experience, a decision, especially like cash, for instance, Alex.
Mm-hmm. Yeah.
You know, sometimes, especially what I've seen for young, dynamic, high income earners that are really starting to like get more sophisticated, they find themselves where they're at a net positive of cash flow. And before you know it, they're sitting on a large chunk of cash and it's like, I don't know what to do. It's like, I've never had this amount of cash before and I don't want to see it go away. And if I invest it, the market's at all-time high, so I want it to go down and maybe I want to buy this property, but I also need, I know, my money to be working for me long-term. It's like, these are real life questions. Yeah. But the bottom line is, it's once you know the different paths and how they work, how they operate, how they would apply to your situation, look at the entirety of your situation, you feel confident about the decision that you make. So when you make it, even if you run into some turbulence, which hopefully is forecasted in that decision that you make, you stick to it. It's called sticking to a strategy. It's called being disciplined. But to be disciplined with a strategy, it's got to be a good strategy. You got to understand the strategy. And that's usually when a good financial advisor being in your corner is extremely helpful, at least in our experience. I'm Jeremiah Bates. She's Alexandra Lundgren. We're fiduciary financial advisors. And on this topic of the plan, the strategy, there are tools that the financial industry across the board uses to help put together those forecasts, to help put together these projections, to help someone understand. I mean, let's just use an easy question. If I retire with $2 million a year and I'm spending $80,000 a year, am I going to run out of money?
That's a pretty normal question, right?
And maybe it's maybe it's 2 million, maybe it's less, maybe it's more.
And sometimes it's, do I have enough to retire?
Do I have enough? I think that's probably the main question.
I think that's usually what we get the most is, do I have enough to retire? Which is not a complete question yet. It is a complete question, but we don't have enough facts yet.
It's a bit vague.
Yeah.
You know, but again, when you're approaching retirement or you're on the cusp of retirement, just like, you know, when you ask a client that question, it's like, well, when do you want to retire? I want to retire yesterday. And
okay.
It's like, okay, all right, well, let's see. Or there's just this preconceived assumption that, I got to work for 5 more years.
Well, and I find a lot of people come in with this idea of a number in their head. There's a goal of how much has to be accumulated because they're like, well, I read someplace that you have to have $3 million to go into retirement or whatever that number is. But I feel like they either come in with a number they think is their target number and they're not there yet, or I'm not X age yet, so there's no possible way I can retire.
This is a couple years ago. Maybe this is about 3 or 4 years ago. One of my best friends, we've known each other since grade school. Still great buds. We live in different states, but it's one of those friends that even if you don't talk to for like 6 months to a year, you just pick up like it never left off. So we were catching up a couple years ago. I'll never forget the conversation. And he's like, well, how much money, and he's progressing in his career, making, pretty good amount of income, net saver, doing all the right things. He's like, tell me how much money I need to retire. I'm like, well, there's more to it. He's like, no. He's like really trying to impress me. He's like, give me a number. Is it 2 million? Is it 4 million? Is it 5 million? I'm like, the answer depends. I'm like, it really does. And it's like, there's so many different ways that you could look at of it being a just standard headline number. It truly is. I mean, because maybe that number's too low. Maybe it's right in the sweet spot. Maybe
your Social Security amount's different. Maybe you want to not count that. Maybe you've got an inheritance that's going to happen at some point. We don't know when, but at some point. I mean, there's so many variables.
Well, especially on the inheritance side, it was interesting. I had a conversation with a client, and I met with him last year. He was in the similar spot where, luckily he was offered a pension. I would say luckily. I mean, hey, that was kind of the protocol in his career path that he chose. And he kind of came in and like immediately when he sat down, it was like, I want to retire, but I know I'm not even close. Like that was kind of the main takeaway. So, we're diving into everything. What does the pension look like? What does Social Security look like? If they're married, filing jointly, so there's 2 Social Securities. It's like, how do we take the pension? What's your spending? What is the liquidity around the other side? Like, we just looked at everything. And it's like, actually, you're working by choice. Like, what do you mean? It's like, well, this was pretty easy. It's like, well, here are your inputs, and here's what you told me that you want to spend.
Yeah.
And luckily, I want to say, again, don't want to use that word luckily, but in this case, the pension allowed for the 401k to be used to actually buy more, essentially, like credits within the pension.
Right.
And they preferred that. They
want known amount.
Exactly. They wanted to have that known amount, and it's like, well, based on these projections, like your income is going to be more than what you're spending. And his eyes opened. I was just like, geez. And I was like, oh yeah, by the way, you'll still have liquidity inside of your 401k that allows you to have that buffer to like enhance quality of life, because you wanted the spouse, health is in question. So the main takeaway of that meeting, and that they were holding in highest precedent, like on their totem pole of like priorities, was like, we don't know how much longer health is going to be good. It's like, we want to capture that now. Like
time is a factor.
These next 5 years are like, we want to hold sacred. And this is when we really want to do some fun stuff. And it's like, well, here's how you do it. I mean, it was on paper. It was great. So they were all happy leaving. It's like, man, I can't, feel so much better. And fast forward the clock. So we're a little bit over a year from the last time we met. And he's like, hey, I need to meet with you. Things have changed. And that's exactly it. Parent passed away. There's going to be inheritance. The other spouse, their parents are aging. So, now there's a relatively sizable amount of inheritance that they'll receive pretty much tax-free. It's like, does this change anything? I'm like, this changes everything. I'm like, again, it's not like you want to show optimism in that situation.
Right.
But again, like the takeaway in that meeting again was like, hey, it's just the reality. Like, we don't want to look at this as like some positive windfall. It stinks. There's obviously the emotional component, but there is that reality where if you have a parent that lists you as the beneficiary, they age and they pass away, you're going to inherit it. So having a strategy around that's good. So I just wanted to, it was just funny you brought up the inheritance side, and we had like a real meeting conversation with the client on that. But when we're talking about these forecasts or these tools that are available for advisors or even for individual investors.
Oh yeah, you can find these online, and
you can find them online. You got to probably run it through some AI, or maybe your employer plan, like your 401k, gives you that.
Oh, those tools.
Yeah, if you want to call them that, right? I mean, it's like, hey, here's this tool. It's a miter saw that can, it's got the bevel and it slides. It's like, I could do a lot of stuff. It's like, hey, I just need to chop the wood, right?
Right.
So it's like you look at these tools that are on there, and most of the time it's in the form of this gauge. Yeah. Where it's like
a percentage.
It's a percentage or a gauge, and if it's not looking good, it's red, and then if it's looking better, it slowly gets to a better shade of orange, then light yellow, and then you start to get in that green area, and that usually coincides with a percent next to
of
it, where
success is what they say,
like a probability of success. Yeah. Meaning if you're in between that 85 to 99 or 100%, you could take that away as like, wow, I'm on track. I'm gonna make it. And what we're here to really unwind or dive into is these tools, how to view them and understand their role in your whole planning process. Because we have these tools, Alex, we use them, we lean on them. But it's important, again, if you're going to develop your retirement strategy around just a number that gives you a high degree of confidence that you're going to succeed in retirement, you got to know what it means. You got to know what does it represent truly? What this Monte Carlo simulation actually means to you. Is it something that you should lean on, that you should take as complete financial gospel? And we're going to dive into it. Why it's important, the takeaways, and some things that you should lean on, and some places where it certainly can fall short. So again, it's your retirement. You gotta have a high degree of, dare I say, certainty that you're not going to run out of money.
Before you turn off that paycheck.
Are these tools going to do that for you? We'll talk about that when we come back. This is The Real Money Pros. We got to take a break. Stay with us. Hope if I unmuted my mic there. Welcome back to The Real Money Pros. I'm Jeremiah Bates. She is Alexandra Lundgren. Again, phone lines are open. If you want to call us, talk about these financial planning tools. If you're looking at a gauge on a screen that makes you feel good, makes you feel bad, shows that your plan's going to fail, or show that it's undeniably going to succeed, call us. We can give you our thoughts on it. 979-59-MONEY. You can also send us a text message to 979-596-6639. And here's the deal. As we talk through topics like this, one thing becomes pretty clear. Good financial decisions do not happen by accident. Whether you're navigating retirement, taxes, business decisions, or looking for more clarity around your financial future, having the right guidance matters, and that could be in any aspect of life. If you'd like to get connected with a fiduciary financial advisor who can help you with these vital decisions and strategies, visit therealmoneypros.com. Again, it's therealmoneypros.com. Click Find an Advisor tab, and we'll help you connect with an Apollon advisor who's a partner of us, who's a good fit for your situation. Again, that is therealmoneypros.com. It's where you can find our educational content. We're not here to sell. We're here to guide. That's it. We're fiduciary advisors. There's no secret product that is going to be the fix-all for everything. We're not here to scare you of like, oh, the market volatility, and here's this item that fixes that, and you can have your cake and eat it too. That's not the case here. We're here to educate you, talk about your specific situation and strategies that have withstood the test of time, and how it could save you money, get you better returns, get you more efficient around taxes, so your desired outcome becomes extremely efficient and you're not leaving money on the table. So Alex, we're talking about these financial planning tools, Monte Carlo. So Monte Carlo. So if you've met with an advisor, or you're looking at these tools online, whether it's through something that you found or it's through your employer plan, and it's shown this degree of success, that's what's referred to as a Monte Carlo simulation. And
it is a snapshot in time only. I mean, it is where everything is right at this moment, and then we apply the hypotheticals.
Yeah, so let's imagine you got some cash, you got some money in your 401k, maybe you got some Roth IRAs, and that's the only thing it's looking at, right? Generally, that's what Monte Carlo is going to do. It's going to look at your assets that could be subject to market volatility. And what this Monte Carlo does, what this Monte Carlo analysis does is it does not assume the market, your accounts are going to earn the same rate every year, assuming that they are invested, right?
So it's the way they do it is it's a capital market assumption based on historical returns back to 1871. So, and then they just kind of scramble them up every time they run a scenario.
Yeah, and it runs over 1,000 different market scenarios. And within those 1,000 different market scenarios, some of those years in that analysis have really good returns early. In some of those scenarios, there's market crashes really early. Some have high inflation. Some have long bear markets. Some have bull markets. It's kind of just scattered across the board. And after running these simulations, based on what you have, your inputs, if you will, it's gonna arrive at, will you succeed? Like, meaning, did your plan succeed in 84% of those simulations? Did it succeed in 90%? Did it succeed in 50%?
And what does succeed mean?
There you go.
It's
a really good
point. In all these 1,000 calculations, what succeed means, according to that Monte Carlo simulation, is that whatever death age you've put in, when you die, you have at least $1 left, unless you've put in a legacy calculation, and then that would be required to be left. It doesn't have anything that says maybe you change spending. It doesn't have anything that says this expense might go away, unless it's something that you can turn off, but you can't randomly turn it off. It doesn't, it doesn't really change what your prediction is, your life prediction is, which most people will underpredict their life expectancy, by the way, by about 10 years.
Really?
Yeah.
Interesting.
Yeah.
Okay. All right. So
That's a Social Security statistic,
when
by
you're
the way.
when you're looking at your expiration dates, make sure you're not underestimating. It's funny. I'll meet with clients and they're like, "There's no way I'm going to make it till 95." I was like, "Okay, I get that, but
just in case,
I don't want you and I to be sitting here when you're 95 and you're rocking and rolling like, I'm out of money." It's like, no, let's just make sure that we can put some stress on this, and then we can make point in time decisions based on the inevitable curveballs that will be thrown in your life that the Monte Carlo simulation cannot account for. Listen, this Monte Carlo or this little graph or this probability of success that we're talking about, if you're looking at these or an advisor has been presenting those, essentially the takeaway is this. You don't look at it, and if it's in the red or shows a likelihood of the plan failing, that you are SOL, right? And it also doesn't mean that if you have a great degree of success that you got nothing to worry about, because again, it's all based on the assumptions that these simulations are running. Now, one thing I do appreciate about these Monte Carlo simulations is that it does not assume that you're going to get a stated growth rate automatically year over year, like a linear growth rate where it's like
we apply a 6% average every year,
which means, that 100,000 that you start in year one, then that the next year, it's going to be 106,000. And then that 106,000 is going to get 6% on the next year. And that's going to get 6% on the next year. That is not reality.
Not with investing.
So when you look at the Monte Carlo, you're the one thing that you can appreciate is that it does represent that there will inevitably be market volatility. And if there's one risk that you have to make sure, in my opinion, and Alex, I'd love to know your thoughts, when you decide to retire, it's what's known as sequence of return risk.
Right.
Meaning, if you retire in year one, you run into a prolonged bear market, that can change assumptions dramatically.
But there are ways to mitigate that.
Now, there are ways to mitigate that, which we'll get into. But the main thing is with these Monte Carlos, you got to understand what's going into it. And a prime example of this is I was working with a client, and the Monte Carlo simulation, it said it was a good success rate, but I'm like, they just had really good questions. Like, well, what does this actually mean? Like, I'm seeing this 95% success rate. It's like, how are we arriving at that?
They want the spreadsheet.
Yeah, they want the spreadsheet, which, hey, I appreciate. I'm a nuts and bolts guy. Like, I want to see, what is the data actually going into this, pretty number that's supposed to make you feel good.
That's a great question,
Which it is great. And you look behind what you could call a ledger or the data input or the assumptions that the plan is running, like it's actually...
You get the spreadsheet.
You actually take away from that Monte Carlo is an account that we earmarked for long term that they wouldn't touch for probably 15 to 20 years. Monte Carlo, a lot of times, isn't able to be that nuanced. Like, it's going to say, oh, that account that you're not going to touch for 15 years, well, in year 2 of your retirement, it's actually down 13%. And by the way, that large withdrawal that you were going to do to fund this goal, we're going to pull it out of that account. That is where these types of tools, there's a bit of...
You can't nuance them that specifically.
And it's a disconnect between the reality of your situation and what this overall... arguably painting with broad brushstrokes Monte Carlo simulation does. I'm not saying that this is a useless or tool that shouldn't be used, but you have
we should use it differently.
You got to understand what that number actually means, how it's arriving at that. So your decision-making protocol is just that much better. Like, that should not be the only thing that we're looking at, because you also got Roth conversions. You got the tax situation. Alex, you mentioned it. What if you get an inheritance? How are we going to receive Social Security? Like, all these things are just as important. And let's talk about how we can mitigate that sequence of return risk. If you're worried about a bad market when you retire, let's make sure that you're prepared for that. We'll be right back. And we're back. This is The Real Money Pros. Again, phone lines are open. We are live. You can interact with us. So you got a question, send it our way. 979-59-MONEY. That is 979-596-6639. You can also send us a text message to 979-596-6639. You can send me an email, jeremiah@therealmoneypros.com. Happy to answer that question on air. You can also send Alex, ALEX, @therealmoneypros.com as well. Again, therealmoneypros.com is where you can find us. Tap into our educational content. We're trying to get something out there at least weekly, if not more, on top of the podcasted shows that we do weekly as well. So again, we're not here to sell. We're here to guide, give some education, help you make better, more strategic decisions based on real life interactions that we have with clients. It's like I explain, anytime I'm in that season of life where, my daughter, what is she in, first grade? So she's just on summer break. So Tori will be second grade. I don't know, August, September, around there. My wife's in charge of all that. I'm just like, okay, she's back to school, or she's out of school. Great, let's have some fun. But I'm in that season of life where I'm meeting new people, because people that I probably would otherwise meet with, because you have connections through activities in school, activities in sports, and all that. And inevitably, the question comes up of what do you do? It's 80% of my time, I am a fiduciary financial advisor, and 20% of my time, maybe that number is actually getting a little bit higher, radio show host and doing the Real Money Pros.
Oh, I thought you were going to say marriage counselor.
There's a little bit of that there too, right? Again,
well, yeah, I mean, we have to navigate the fact that spouses come from different emotional standpoints a lot of time on Monday. That's education as well.
It's funny. So obviously we're on the top of these financial planning tools, specifically the Monte Carlo simulation, which you could also look at as if you've worked with an advisor or you've seen it on your account dashboard. You see this gauge, this graph of success of the success of your retirement when you actually decide to start living off of your assets. That's what we're talking about. And we're diving into what actually makes up that number and the positives and the arguably negatives of that, and how you can. So the more you know these things, then you can actually realize, okay, what does that number actually mean? And if there's one thing amongst a lot of things that the Monte Carlo does not take into consideration, is the emotional component.
Absolutely.
If we could look at our investments, our money is just ones and zeros, or just that mathematical formula, and just be robotic about it, hey, it's great. I think you'd see success across the board, which again, that market volatility, which is a feature, not a bug, that where people get rewarded is the emotional side of things, right? So you kind of almost want that there. And that's why disciplined strategic investors, they just have such a leg up on having success versus someone who is just at the mercy of the whipsaw of the market, and it's just an emotional tornado where they want to get in, they want to get out, they read a headline, they get worried, or they want to buy this stock that's up 3,000% over the past year.
Sell it when it goes in half.
And you haven't really identified why. It's listen, that's the human component of it. And I'll be the first one to admit, I fall victim to that. I'm dang it. Fear of missing out. It's I had a thought I should have.
Oh, I do.
I should have invested in that.
Some investing in my own account I would never do for a client.
Yeah, it's your bucket.
But I know I've got the extra.
It's your risk money that's not tied to the success of your retirement plan.
Absolutely.
Alex. So you've done that calculation, and hopefully
I will never put my personal retirement at risk.
which is smart. But again, with these tools that you have from a financial planning standpoint, that's giving this projection of success based on previous market volatility, and maybe that number comes out good or bad, it doesn't take into consideration the human component. It's gonna this calculation often miss the tax strategies that are involved. It's gonna miss income design, meaning how and when do you take Social Security, your pension? How are you designing a cash flow plan with your investments? Because, and I'll say this is probably one of the biggest things here, where we talked about. I
think this is a huge part of it.
We talked about sequence of return risk, and I think that's one of the biggest risks for someone who's in retirement, where, hey, we're on all-time market highs. Let's imagine you're going to retire next week, and you're like, hey, I'm good. And you left those investments as is, and then we see a big market drop. You could see that Monte Carlo number that you ran last week, your projection of success, maybe get cut in half depending on what the market does. So how do you mitigate that? You have to have that balance, or I would say I'd say it's probably, in our opinion, in our suggestion,
very important
that you have that balance between what you need for liquidity, which is your peace of mind, sleep easy. If the market does something wild, which inevitably it will, your
cash flow is still good.
Your cash flow is good, meaning your goals, your needs, like everything you need from a spending standpoint, you've actually solved for. Looking at your situation and your numbers, you've solved for how much money needs to be in that liquid bucket of money.
Right.
So you basically insulate yourself from that to a point, that sequence of returns risk.
Yes.
Because then if you retire and you see a big market drop, well, you know that you're not you're not drawing off of accounts, you're not drawing off of investments that are just falling precipitously.
Right. You're not being forced to, sell something that you don't. It's not a good time to sell just for your cash flow needs. Because honestly, in retirement, cash flow is the only thing that matters. Is that paycheck showing up still?
Oh, yeah. You got to know that it's there because you retire. You no longer have it coming from your employer. It's got to come from other sources. So again, the Monte Carlo side of things, it's not going to be able to tie that down.
It doesn't.
But a proper investment strategy that's solved for will. You got to look at healthcare, long-term care, like these expenses that could be accelerated down the line that you maybe don't necessarily need to worry about for the next 10 or 15 years, perhaps if you retire in maybe early to mid-60s. Market behavior, right? I mean, there's something to be said about, again, we're talking about emotions. If you see the market drop 10%, okay, not feeling good. Drops 15%, whoo, 20%, you get into 30%, 40%. That's where those emotions that you start to feel that existential crisis, like I have to do something because I can't lose this money. It's like that's why that pre-planning or that strategic approach
makes a big difference.
Well, it helps you be disciplined. It helps you follow that. And then also too, you have market changing, you have tax law changes, you have healthcare change, your family needs might change, spending changes. I mean, these are all things that are a part of the plan that largely this planning tool, the Monte Carlo simulation, it cannot account for.
Correct. Yeah.
So again, Monte Carlo, it's there. You can look at it, but if you don't understand it and what's going behind it, find out why. Like find out how it actually applies to your specific situation and understand that Monte Carlo situation is only going to apply to the data you put into it.
Yeah.
By the way, and Alex, you nailed it, how long your projected life is going to be.
Yep, right.
Are you underestimating it?
And so here's my question. What's a good number?
In regards to...
If you want a percentage on that Monte Carlo, do I need it to be 80%? Can I have it be 30%? What does that mean?
Yeah.
I mean, that's... And what I'm going to say is it depends because it depends how you're looking at it. If you are going to take that one time in isolation and that's the only time you're ever going to look at it, you want that percentage to be higher. However, when you look at things mathematically, what that number should be is the frequency at which you might have to make changes. Not that you're going to fail, but maybe what your target spending will need to be adjusted up or down. So if you've got a 50% chance, that might mean that 50% of the time we might look at you again and say, oh, we got to reduce spending because of this or that. Or quite often, it's usually, if you have that cash set aside, it's an unexpected large expense that is going to have to reduce some current spending if the market's down right now. So it's we didn't know we were going to have to get a new roof or, just a health thing that has a high expense. Those are the things that'll usually force that.
What about overspending? Like, do you see that?
Yeah.
Like,
They go a little wild.
I see the pendulum swing the other side. It's either they get clients will get really tight because it's like, they've done a great job. And it's generally the ones that have been prudent, delayed gratification, all of that. Like the numbers state that no, you're fine. Like you're good, but they just it's like, it's a big transition. I gotta make sure I don't run out of money. And they're just underspending their plan. Right. I've seen that. I think that's more common than the other side. But I've certainly seen it where maybe that overspending doesn't happen right away, but hey,
they ease into it.
5 years ago, and this is like we account for inflation, and honestly, the plan should. Like your plan should account for some cost of living adjustment that's going to compound year over year. So we account for that, but there's been a handful of times, maybe more, where 5 years ago that projected spending. Now where we're at, and it's significantly higher just on an annual basis. And that could be a little bit of human nature.
The ones that I always worry about are we're making $150,000 a year, but when we're in retirement, we only need 36. And I'm like, I'm going to ask you to live on that for the next 6 months before you retire. And then let's talk about it. Because could you live on that? Sure. Do you want to live like a college student again? I don't know about you, but I'm never buying single-ply toilet paper again in my life. So let's have some real expectations.
Yeah, you got to look at the reality of your situation. Like, think it through, visualize it. Because you retire does not mean that your quality of life should drop off, that you should feel good about pulling back spending so you see that number either grow or stay stagnant. That's not necessarily a measure of success. We'll be right back. We are back. I am Jeremiah Bates. I'm joined with Alexandra Lundgren. We are fiduciary financial advisors, live financial program. Obviously, we're talking about tools that are at your disposal, whether you've met with an advisor or you got some type of investment dashboard that is giving you some insight into your retirement. It's giving you some gauge of success, how you should view it, where it falls short, where it can be used as a useful tool, but it should not be on its own looked at as the main foundation of your retirement plan. And that could be said for a lot of things. But again, you want to change the topic, you got questions about markets, retirement, taxes, estate planning, call us 979-59-MONEY. You can send us a text message as well. It is 979-596-6639. Visit therealmoneypros.com. And the reality is, good financial decisions do not happen by accident. You got retirement, taxes, business decisions, and you're probably looking for more clarity around your financial future. You've probably heard of some little one-off strategies online of maybe it's tax loss harvesting, Roth conversion. Should I convert? Well, I don't know. We got to look at all the other moving parts to see if it's a good idea so you know exactly what the tax ramifications are going to be. And do you have enough time to let that money grow? And also, is it invested? How do you view it? Like, that's just a small piece of the pie, and the right guidance on these types of things matters.
Yeah, absolutely.
If you want to get connected with a good fiduciary financial advisor, visit therealmoneypros.com, click on our Find an Advisor tab, and we'll connect you with an Apollon Wealth Management advisor, a fiduciary advisor who is a good fit for your situation. Hey, it might be me. It might be Alex. It might be someone on our team. It might be someone in South Carolina, North Carolina, somewhere in
Atlanta,
California. I mean, you name it. We got great advisors across the country, great resources here for you. Okay, so Alex, let's talk about this. You know, we have this Monte Carlo situation. You're seeing some gauges on this of like, hey, it looks good, it looks bad.
Yeah, I want to pick on that. What's the right number?
Let's do it. Because if you see it in the red, like a 50% probability of success. Like, what does that mean? Should people be worried about that?
So, yes, no, maybe, right? So what I want to talk about, there was a study that was done using the Monte Carlo. And remember, we talked about it's a one moment in time projection and all the things that it cannot take into account for, and that really it should be viewed as you might have to make adjustments. So this study was done. The hypothetical is a couple 65 and 64, $3,500 of their monthly income requirement is being covered by Social Security, and then they need the additional out of their accounts to get to $6,000 a month. They have $2 million. We put in inflation and run Monte Carlos, right? So we want to make sure we are keeping up with inflation in this spending scenario. They took then 20% chance of success up to 95%. So a 20, a 50, a 70, and a 95. If every year they reran the Monte Carlo and adjusted spending up or down to get back to the initial percentage that was used, regardless of which one it was, it carried out all the way through. And honestly, the spending difference was minimal between all those scenarios as far as, what they spent. Any difference was on the downside from where they started. $1,000 or less was all they were looking at as far as having to reduce spending, which as we age, we tend to do anyway. We spend more in the beginning of retirement than any other time because your health is good. You can do all the things you've been putting off. Maybe you've got some purchases like a camper or something that you didn't have, but now you get to enjoy. You don't spend near as much 10 years into retirement as you do early on.
And I appreciate you said that because as I show a lot of focus on that now with clients where, yeah, I mean, if you want to just say, yeah, I got a 95% success rate, it's going to assume that I'm spending $100,000 a year with the rate of inflation, and I'm going to live till 95. Okay, that a lot of times that is the base, and you see that, and you're like, great, and there's no nuance or like anything on top of that. In my opinion, there's the human nature and the reality of it. And Alex, I would agree, and I've certainly seen it, that my anecdotal take is that there's this subconscious switch that flips that, when you hit your late 70s and early 80s. I'm not saying this is the case for everyone, but spending just tends to drop.
Yes.
And arguably you become a net saver. You actually have more money coming in than actually what you're spending. So it's great. It's like, so based on that, let's start running some scenarios. Like, let's dive into your cash flow plan and what the projection would look like if we really accelerate spending in between 65 and 75, where you have, hopefully you have your good health, like the best of guess that we can do, and you have energy and you have some impactful ways that you can spend money.
Right.
Let's test that. Let's see what that looks like in the overall plan of a higher degree of spending of maybe over a 5-year period, maybe a 10-year period. And then we start to taper it down when you hit your, your no-go years, as I heard it called. You got your go-go years and then your no-go years where you're just not doing as much because you and I'm not saying people that I've worked with who are in that scenario, like they're happy, they're great, they're happy, they're content. They just don't want to. They don't want to go on the big trip and spend all this money, and they're gifting a little bit, and they're totally content with their situation. And they're well of the understanding that, hey, when we pass away, we're likely going to leave a sizable inheritance to someone, and it's just the reality, right?
Well, and I guess part of it, to me, back to this this percentage of success is, if you start out with a really high percentage of success and then you end up with leaving behind as much as you went into retirement with or more, when you're someone who told me you don't care if there's anything left for the kids or not, well, then two things happened, or at least one of the two. You either retired too late or you underspent, but probably you did a little of both. Mm-hmm. So what are we doing? Let's not do it.
And that's why that's why having a good plan put in place, like working with a good advisor that can look at all these aspects of the plan, are really important, because it takes away the mystique of, what are you going to pay in taxes? Right. It's going to take away the mystique of, what if I have good market returns or bad market returns? What if I spend more?
What transactions or movements do I make in those scenarios?
What if I have a long-term care event? Is all my money going to go away to paying for long-term care costs? It's like, well, let's dive into this and see what this reality actually looks like for you specifically on everything that you've done and what we anticipate in your situation to happen. Again, phone lines are open, 979-59-MONEY. That is 979-596-6639. We got a text message coming in. I'll kind of summarize it here. 63 years old, planning to retire in a couple years. I was shown a Monte Carlo analysis. It had an 85% success rate. What assumptions are actually driving that number, and how much can changing one or two things impact the result? Well, I think we pretty much well covered it. It's a great question.
Change the result drastically with very small changes.
Well, generally speaking, what's going to go that? Like, what assumptions are driving that? Obviously, we talked about past market volatility. That's going to be so it's going to do 1,000 different trials, mixing up different market events, and it's going to take a snapshot of how you're invested, or if you're invested, like meaning if you're just in cash and there's no assumption that you're going to get out of cash or a very conservative investment.
Yeah, you're going to fail because of inflation.
Well, maybe not. Maybe it's like
if you've got enough not to, then that's a whole different story.
Exactly. I agree with you. But let's just imagine you're sitting on $5 million of cash and you're spending like $50,000 a year. It's probably going to
fine.
But what you'll see is that there's not going to be a big degree of difference between the good market years, bad market years, and your average market years. Think of back to statistics class. That's standard deviation. You have that bell curve. That's the majority, right? That's generally what the Monte Carlo is going to, like working with clients, it's like, we want to look at your average market years. Like, you have your outliers, your really bad market years, and your outliers of your really good market years. But that's certainly going to be assumption. The assumption is also going to be, how are you invested right now? And it's going to be based on that, number one. So are you invested? Are you not? What type of investments are you in? That's also going to drive that number. And it also comes down to the other inputs. Did you put in different income sources of when you're going to file Social Security? Is there a pension? Is there any assets that are going to be sold that's going to generate a tailwind? Is it going to be some type of inheritance? So, yeah. And the next question was changing one or two things. Does that change the result? A few variables? Absolutely. 100%.
Well, and sometimes as little as $50 a month difference in spending can make a huge difference in the percentage that pops up the next time. It's very fascinating when you spread it out over a long life expectancy. Small things are different.
If you see that number of success, understand what it means. If it's good, bad, or ugly, so you can make the adjustments. We'll be right back. And we are back. This is hour 2 of our 2-hour live program. Live meaning you can interact with us. You can call the program. You can text message the program. You can email the program. The phone number is 979-59-MONEY. That is 979-596-6639. You can go to therealmoneypros.com. It's one of the best ways to get not in contact with us, but get exposure to us, see what we're all about. We're a sponsor-driven program. We are not here to sell anything. We are here to give education. The more education you have, it arms you with information to allow you to make better decisions, at least in my opinion. I'm Jeremiah Bates, joined with Alexander Lundgren. We are fiduciary financial advisors here for you. Any topics that you want to hit on, whether it's taxes, retirement, college, highly appreciated stock, what the markets are doing, how we view things going through the end of the year, call us, send us a text message. We actually have a text message that came in through the text line, so I want to jump right into this because I think this is something that is certainly applies to a number of people, and this is kind of around this idea that when you receive compensation, it's not always in the form of just a deposit going into your bank account, which then you have to then turn around, invest, spend, and all of that. So the question is this. I had a large RSU vesting this year, and it was surprising to hear that I still owe additional taxes. If taxes are already withheld when the shares vest, why would I still end up with a tax bill? Okay, so let's dissect this a little bit. So
let's do some vocabulary definition.
There you go. Yeah, let's Alex, give us the update of like RSUs, like what that actually means, how he's receiving it, like how this space works as far as non-traditional compensation when you're an employee.
So an RSU is a restricted stock unit, which in the simplest form means that the company gives you what they call restricted stock at a point in time, whether it's a hire, it's a anniversary, it's a bonus, however they do it.
Meaning they have a defined schedule. Sometimes it's up to their discretion, right?
Correct.
And sometimes it's by a defined schedule.
Yep.
It's black and, it's basically just set by certain terms. And other times it can be discretionary. But bottom line is, as a form of your compensation, how they determine you actually get ownership of the stock in that company.
And typically those restricted stock units, the reason they're called restricted is because you don't actually own them. When you first get them, there is a schedule at which they vest. So let's say they give you 100 shares.
So it's like you're entitled to it, but you can't do anything with it.
Right, until a certain period in time. So maybe it's 100 shares and it vests at 20% a year for 5 years. Well, after the end of year 1, 20% of those 100 shares vest, which means now they're not restricted anymore. It's 20 shares of that company stock you now own.
You're in complete control of.
Complete control. You can move it to a different account. You can sell it. You can gift it, whatever you want to do. It's now yours. But there's still 80 shares there that are restricted. Year 2, you get another 20, and so on. But what this person's talking about with the stock when it's vested is when those shares vest, whatever their value is at that point, not when they were gifted to you, but when it vests, there is automatic withholding done from your payroll taxes to pay for it. Or you can have shares sold to cover. If you don't have that done and paid up front, you'll have to come up with it at tax time. But they tax it like payroll.
So if I was going to summarize that, if you are an employee for a company that does offer restricted stock units, which is certainly the case in this question, they're awarded, aka gifted, that stock per the terms of that employer, and it's held in some type of an account that you're entitled to have, right, at a future date, but you can't do anything with it. So if there's a vesting schedule on it, and that vesting schedule, like you said, it could be over a certain period of time where, if you get 100 shares, to your point, if 20% year 1, then that means after that date, you get 20 shares. And then that so forth and so on, depending on that vesting schedule. So maybe it's a completely vested over 3 to 5 years. Okay.
Right.
So assuming that's once all those are once you hit that vesting date, depending on the market value on that date, it triggers a taxable event, meaning
correct,
you are actually receiving that on your W-2 income as compensation. It's not a capital gain. It's not a long-term capital gain or short-term capital gain.
It's just basic income.
Like, hey, this is a part of your compensation. It's just not in the form of cash that's hitting you, but it is still under your W-2 realm, right? So now since you vested and now you can control it and you can do whatever you want with it, the tax implications hit.
Right.
So you could argue that is the tax level number 1.
Correct.
So now let's look into where there could be another taxation on it is when you actually sell it.
Mm-hmm.
Okay, so let's imagine that in this scenario, the question is, I had a large RSU vesting this year, and if they sold it, so like, okay, cool, I got 100 shares of whatever, I'm going to go sell it. Because let's just imagine it's a publicly traded company. They sell it, they get that cash, and they're good. And maybe they were expecting that, okay, I just got to pay capital gains on that. So obviously, assuming that and it could be a gain or a loss, by the way, but is that basis, and we'll dive into this a little bit, but is that based on the awarded value or the vesting value?
Vesting.
Okay. So
because that's what you've already paid taxes on.
Copy that.
Yep.
So in this case, the question comes down to, it could be a little bit surprising. I mean, the real reason why you end up with 2 tax bills, bottom line is that in the form of RSUs, you pay taxes as far as receiving it as compensations. That's ordinary income because you're receiving that on your W-2. And then when you actually decide to sell said stock, then you're likely going to pay a capital gain, assuming that the shares are higher in value, or you might actually book a capital loss. So that's why it's important to understand just the tax dynamics of that and how these our RSUs operate.
And whether that gain is short-term or long-term, it depends on how long you've had it since it vested. Not since it was gifted, but since it vested. So once it vests, that's kind of like your clock. And you have to have it longer than a year for it to be long-term capital gains. Otherwise, it's short-term, which is taxed the same as income. Now,
you could also look at the other tax ramifications that would come with that is if, let's imagine you don't have any other investments that you've normally sold, right? Like maybe all of your money you've been deferring into a 401k, traditional IRA, or a Roth. So, you're not normally selling stocks at a gain or loss or assets at a gain or loss. And then you're with this company and then you get that first vesting and then you turn around and sell it. And who knows where it could be. If you're if you're
some of these are moving fast.
If you're looking at say your Nvidia, there's a lot of employees that arguably have had life-changing wealth events just by getting the ownership of these stocks as form of compensation from these companies. And let's imagine it vests and you're like, great, I'm going to sell it. And if you're not prepared for the tax implications, whether it's short-term, long-term, again, this comes down to how much you sold.
Even the taxation at vest.
Taxation when it vests and potential net investment income tax, how this could affect everything across the board. It's just that old cliche. It's not about what you got. It's about what you keep.
Yeah.
And this is one thing that I've experienced with RSUs is really understanding that because I've met with prospect clients who it's like, oh yeah, I got some RSUs. And they're like, okay, cool. Let's talk about that. And like, oh yeah, I sold some this year. I'm like, oh, okay, let's talk about that. What? And there's been a handful of times where luckily we caught it. And we had some runway within the year to understand that this is going to be a sizable tax that you're going to owe that they were not aware of.
Well, once you get up into certain dollar amounts of earnings or gain, what's shown as income on your taxes, there's additional Medicare taxes, as well as, like you said, that net investment income tax that most people aren't aware of, which basically it's the government saying, if you make too much money, and they decide what too much money is, not you, not me, the government, then we're going to actually charge you an extra level of tax on top of your normal taxes.
There you go.
Because, why not?
And this comes down to the tax efficiency of things where Yes, there's the investment component where you get some RSUs. It could or it may or may not be a big windfall. It could be life changing, maybe life changing, but certainly like changing from like a wealth accumulation standpoint, which is great. But also understanding how the taxation of it works. Just make sure that number one, there's no surprises, so you don't feel as a giant kick in the gut of like, I thought this was this great thing, and now I owe like $50,000 in taxes. Like, what is all this about? It's just the logistics of how these RSUs work, these restricted stocks units. Again, phone lines are open 979-59-MONEY, 979-596-6639. You can call us, send us a text message. This is The Real Money Pros. We got to take a short break. When we come back, let's talk about more of these company stock plans and how you can capitalize them. We'll be right back. And we're back. This is The Real Money Pros. Again, phone lines are open. 979-59-MONEY. That is 979-596-6639. Give us a call. Send us a text message. We are here for you. You want to talk about tax efficiencies. You want to talk about Social Security filing. You want to talk about IRMA charges through Medicare, proper estate planning. You want to talk about asset protection through various trusts. Maybe you're running into a taxable estate. You fall in that category of cash poor, land rich. I had an interesting meeting this past week.
That's a real thing in some areas.
It's a real thing, and you look at the value of the land. It's like, we're looking at a taxable estate situation here. So we got to dive into this.
Leaving your heirs a tax bill.
Yeah, and that's another issue where you're looking at an illiquid asset that could be the linchpin of actually causing a taxable estate. So then would have to sell said portions of that, and it could just
you may not want to. It may devalue that
100%. So again, just luckily in this case, we got a lot of runway. Hopefully, we're going to knock on wood here, but these are things that are real and that a lot of people are dealing with, and that amongst a lot of other things. So again, reach out to us 979-596-6639. And hey, listen, as we talk through topics like this, one thing is pretty clear: good financial decisions do not happen by accident. You got to navigate retirement, taxes, business decisions. We're talking about RSUs or stock options right now. But if you're looking for more clarity around any of these things or your financial future, good guidance matters. Having someone in your corner who's experienced, is a fiduciary, it matters. So if you want to get connected with a fiduciary advisor who can help you strategize any of these things or a combination of these things, visit therealmoneypros.com, click Find an Advisor tab, and we will get you connected with a fiduciary financial advisor with a Paul & Wealth Management who is a good fit for your situation. Like I said, you might get connected with myself. You might get connected with Alex if you want someone who's smarter. Alex is who you want to get connected to. But we also have great advisors across the country. We got a great network, sharp people who actually really care. So that is there for you. Again, therealmoneypros.com. Okay, so we're talking about restricted stock units. So if you work for an employer and as a part of their compensation package, you are actually awarded restricted stock units. That restriction term is important because when you're awarded those stocks where it's like, hey, Alex, here's your restricted stock unit. It's like, I can't do anything with it.
Kind of like your little carrot dangling out there.
You could call it like a golden handcuff, right?
Yeah.
Like meaning, hey, if you want to recognize this award that we've granted you, you got to stay on board, right? You can't just like, you got to, so there's that piece of it, but it eventually vests per that schedule. And what's interesting is when it vests, that can cause a taxable event. So it's important to be forward looking on when these things will vest, because it will hit you from a tax standpoint as actually additional earned income.
Right.
Which, again, when it comes to taxes, I think what takes the bite off, Alex, and correct me if I'm wrong, is like there's no surprises, right? Like if you run into a surprise, it's like, geesh.
There's rarely a good tax surprise. Rarely. I've heard of them, but they're infrequent. So usually a tax surprise is a negative. And it's also interesting the different ways that stock can be utilized for compensation or as a bonus or an incentive for employees. They all have a little bit different taxation on them. So if you actually, instead of restricted stocks, work someplace where they give you stock options, that's an entirely different way that they work and how it's taxed. it's similar in that quite often there's a vesting schedule on them, but they're put in at whatever price they do it at that point in time. So let's say it's $100 a share and you get 100 shares. That's the price if you choose to buy it when it vests. So when it vests, you can then purchase it and exercise that option. But there's also usually a limited amount of time that you have to exercise that option. So let's say it's at $100 when they gift it to you. When it vests, it's now only worth $50. You have 1 year, and during that year, it never gets above what the buy price is. A lot of people let it expire because why would you pay more for it than you could pay on the market right now?
Exactly. Yeah, and that's an important thing to note where, and again, the big headlines of these like high-flying tech companies, like those are success stories of like, you know, whether it's restricted stock units or stock options, those are great successes. It doesn't mean that just because your company is offering that, like it's gonna be a success story. But again, you know, if you run into that tailwind where there is a dramatic increase that could be a sizable amount to you that can make some changes in the overall financial picture, then yeah, you want to be smart. You want to be smart around the tax side of things. So it's important.
Yeah. The other thing that we see a lot is it's called an ESPP.
Employee stock purchase plan.
Yep. There you go. I was going to say, I got to think about what that means, but you got me covered. I love it.
Yeah. Well, I mean, so the employee stock, the ESPP
is a whole different animal,
a whole different story because you're not necessarily awarded it. Like you're making the conscious decision. In most cases, to buy that stock at a discount.
Correct.
Right.
And a lot of them, you set an amount that you withhold from your paycheck, and then at a specified frequency, sometimes it's quarterly, sometimes it's semi-annually, whatever it is, it will automatically purchase stock, usually at a 15% discount of whichever's cheaper, the beginning or end date or the average of the time frame. There is something, it's written, it's very specific, it doesn't change without you knowing it. And then you own this stock and it's a discount. Some people figure since I got it cheaper, I can just flip it immediately. And some people just figure it's a discounted way to now own stock. But you've already paid on what the purchase price is as part of your compensation and your paycheck.
There you go. You know, and it's like a part of the thing too. It's like if you feel like you're running into a big tax hit, like, you know, as far as like the sale of it, not necessarily the vesting side of it, you could look at, or let's imagine even if vests, like let's imagine it vesting, it's like, oh boy, like that is going to cause a bit of a tax bogey for me. And it's like, oh, I'd have to sell it to cover that tax bogey. But then if I sell it,
then I don't have it.
And I don't have it. And then I might have to pay short-term capital gains on it. So it's like this compounding tax inefficiency that you can run into. So that's where you got to look at other options, right? Like don't look at this potential tax inefficiency from what should be a good thing is just, this stinks because it's just getting decimated by taxes. Like you can't look at a loan on an island or a vacuum. Like look at other options that could be at your disposal to offset that tax bogey, which could lead to you potentially holding on to that position to let it continue to grow because you're bullish on it, right? And like we've seen that, like I said, we've seen multiple examples of companies that employees that maybe that are on the lower income earning side of things just through these stocks that were awarded to them through stock options or RSUs. Like it's just completely blown their net worth to a level that they probably had no idea that was going to happen, 5, 7, maybe 10 years ago.
Yeah.
So now that could be, you could be in that position. Now we got to talk about, and this is what we talk about all the time. You've just entered into a level of sophistication that you likely need someone who knows this environment to help guide you on it.
Right.
So you're just not shooting from the hip or going off gut feelings or, just clicking the sell button and then you get hit with that tax bill and it just leaves a very bad taste in your mouth because nobody likes surprises, particularly around taxes. Although I'm okay with surprise parties, but one's never been thrown for me. So
me either.
A little nod to my wife Tatum out there. Maybe on my next milestone birthday, you can throw me a surprise party, right? This is the Real Money Pros. Jeremiah Bates, Alex Lundgren. We are here for you. We are live. Any financial questions that you have, send them our way. We're going to get to the phones right when we come back. We are back. This is the Real Money Pros. Again, phone lines are open, 979-59-MONEY. You can send us a text message as well or phone call, 979-596-6639. We are live here for you. Visit therealmoneypros.com. You can get access to our educational content. We are fiduciaries here to guide, not sell. We are a sponsor-driven program. And Alex, between the two of you, we probably meet on an annual basis, like hundreds, well over hundreds of clients, hundreds of households. And
yeah, for sure.
And that's what we do. And one thing I've always said, which is, I enjoy doing the radio. Like it requires and there's a perfect crossover to that, right? Because, when you're an advisor or working with clients, it just gives you real life application to these strategies that we talk about on the radio.
Yeah.
So for listeners, they can say, oh, hey, that I fall in that category. So, oh, perfect. Like it's just good strategy, good education. And then vice versa. I think the benefit of doing the show is that you got to take these, what some would say, boring topics, and you got to throw a little entertainment on there, right? So then it helps you better summarize that to clients that you meet with. So it's a good synergy if I was to summarize that.
Well, and the other thing I like about having, so many different clients that you work with is no person's situation is identical to anyone else's. Every person, every time you meet is different. You may apply the same strategy,
or there's common
but
themes,
it's different.
But no, exactly. What it means to them is different. Yeah, absolutely. I would agree with that. Okay, we were going to go to the phone lines, but the call dropped. But luckily, our producer, Cooper and Josh, they got the question that was going to be asked. I think it was from a caller out of North Carolina. So the question is this: is it a good idea to give my granddaughter a $500 graduation gift under the terms that she puts it into a Roth IRA and matches it, but she's not good with money and not sure if she will ever put money in? So the question is that a good? Well, okay, let's cover this. Let's cover this a different way. So, is it a good idea? If we're looking at the calculator answer, yes, 100%.
Right.
Because the benefit of a Roth IRA, especially at that age, is if Alex, time value of money. And Alex, you ran a growth calculator projection on this. So let's imagine that you gifted your granddaughter, and assuming she does this, let's just go into that assumption number one. If you put $500 into a Roth for her and then she matches, that means you start with $1,000.
Right.
So if you were just going to leave that on its own, I think we put in some.
Yeah, we put in 6% annualized growth on it, which is really probably an underestimation if it's invested into like an S&P 500 index ETF or something.
Let's just use the market. Let's just use the S&P 500 as the vehicle in which that you are going to achieve that market growth. And depending on what you look at as far as historical data, as far as the annualized compounded growth, you look at that number and 6% is going to be pretty dang conservative. I would argue we go 8. I think 8%.
Okay, we'll do 8.
I don't think 8% is out of the question.
So we're starting basically with $1,000. Mm-hmm. She can take it out at age 60, so 42 years from now.
So 42 years of growth, assuming it's not going to be touched, and you're getting an annualized growth rate of 8% when it's all said and done. So let
me double check it, calculator.
All right.
Okay.
So that means that $1,000, assuming you just left it, you did absolutely nothing, it grows to just over $25,000. Okay. Is it transformational? No, but it shows you how such a low amount can compound to that amount. And by the way, it's tax free. That's the big benefit of the Roth, by the way, is that you don't get any tax benefit on the money going in, but all of that growth, when she would distribute that money out at, say, age 60, not going to pay $1 in state tax or $1 in federal tax.
Right.
So you truly have that money in there. But now let's imagine if she did this and she was going to do same thing. Started with $1,000. It was going to grow for 42 years. And let's just say that there was a monthly contribution into that of $50 a month. So $600 a year. But all those numbers stay the same. We're looking at over $207,000. Okay.
So at an idea.
Okay. So I would just say this, Alex, and I'll let you go.
Nope.
Is it a good idea from a number standpoint? I think we pretty much well covered that. The growth of the money on an annualized rate, the fact that it's tax free, undeniable that the Roth is a great idea. Okay. But now, as we always have to with money, we got to look at the emotional component, the human nature component of it. And she said she's not good with money and not sure that she will ever put money into the Roth.
And some of that could be age. I mean, we're talking about
18 years old.
Yeah, 18 years old. So, money's money's still kind of foreign and you've never really earned a whole lot at that point in your life. And it sometimes you have to learn the hard way to get responsible with it, right? But my thinking is, what if Grandma says, I would love to give you $25,000. Here's how we get there.
No, that's so good. That immediately changes it from like,
Yep.
From this, hey, the only way I'm going to gift you this money is you got to put $500 in. You got to make sure that you put $500 in. It's going in a Roth. Because then you got to understand if you gift her that money, she's in control of it. Like,
right.
Bottom line. And even if she did match it and you put $500 and she put $500 into the Roth IRA and she showed you she did it, so let's imagine she opens up the Roth IRA, she puts $500 in, and then you say, great, now you get the $500 I'm going to put in. The next day, she could pull the money out of the Roth IRA and spend it on whatever she wants, right? So
there's got to be some incentive.
Again, yeah. So
you can be comprehensible thing.
You can be a little tactical with how you approach this, because obviously the sentiment for you is great. You're trying to teach them, time value of money and delayed gratification. Like the idea on its own is fantastic, but where a lot of ideas fall apart is the execution. And it sounds like you got a pretty good gauge on your granddaughter. Like, she's not good with money. I don't know too many 18-year-olds that are really good with money. I think that's a bit that I certainly wasn't. It's a bit of a rare bird. But so you just got to maybe get a little creative on how you pose this idea to her. And Alex, I love that, where it's like, hey, I want to give you $25,000, and the ears and eyes are going to perk up, and you say, here's how we're going to do this. And then you can give a little education behind it, right? Then they're going to be much more receptive to it. It doesn't need to be a whole technical breakdown.
They can pull out their phone and open the account right then.
You can pull out the phone, open the account. You can get them started. I mean, all of that. So is it a good idea? Yes. Where that good idea could fall apart is obviously the human nature of things. And that's where you just got to be thoughtful of how you approach that.
And then realize at some point it is out of your control and you did the best you could. Right?
Indeed.
We did that with our kids as they got older and didn't need anything. They had jobs. If there was something they wanted, they were buying it. We chose to do this for them for Christmas one year, is to put some money into a Roth for them. But it was very much an education thing. Their mom knows nothing about money, but everybody else in the world and the computer does, right? And all of a sudden, when we could look things up online and they could see the calculators, it was a whole lot cooler.
Oh, yeah.
So,
well, yeah, and then they're hands-on. They actually see the numbers behind it versus, here's my elder telling me to do this with money. Yeah. And it's just like you can kind of get that eye roll. So, yeah, just, again, great idea. Love the approach, but just be a little bit creative if you know that she isn't quite got a good handle around money yet. And she'll likely get there. But, 18 years old, we'll give her the benefit of the doubt. But, hey, starting now, better than not doing it at all.
Absolutely.
And to be clear, too, so on this point, I want to bring this up is, let's imagine that you have a minor child. So I believe on the call, one of the details is that her granddaughter's 18. So obviously she's an adult. She can set these accounts up, right? Now, if you have a child or grandchild that's under 18 and you know that they have earned income. Oh, by the way, that's another important point.
Yeah, they've got to have W-2 or 1099 income.
So to do this Roth IRA, they have to have earned income, meaning they're getting it from self-employment or they get a W-2, bottom line. So as long as they have earned income, you can go ahead and do this, right?
As long as it's at least as much as is getting deposited.
Yeah, so the limit for a Roth IRA...
So her, it would be $1,000.
Yep, there you go. Now, for the parents out there, grandparents out there that have minor kids that are working, and you hear this message, and you're like, well, I'm gifting them money, through certain times of the year, through good grades, or maybe just, whatever the case is, maybe through Christmas gift or whatever. You can establish a minor Roth IRA. Still, same thing. They need to have earned income. So as long as they have earned income, you can set up a minor Roth IRA for that child or grandchild. You can be the one who's funding it. And then they still get that. You could get them even started earlier than 18 on that compounded growth investment inside the Roth IRA that could grow tax-free. Love the idea. But you also got to understand that when they hit age of majority, which your state is going to determine that Roth IRA becomes theirs.
Yep. So once again, whatever they want to do with it.
And meaning you don't sign something, like it happens automatically. Like that account converts to an account that is owned by that who was then minor, who's now age of majority, an adult in that state. You're removed from that picture completely. So if you try to call and say, hey, I need to get money. I need to get money out of this, or whatever the case is. You can't. That money's there. So again, I like the idea across the board. Whether you want to set this up for a granddaughter because she's 18, get that money in the Roth, or you want to set up the minor Roth. But give the education behind it. Give the idea why. You might have to get a little creative so that message really hits with that younger adult or minor child. But in my opinion, I think it'll pay dividends over the long term. That's why my daughter, I have her invest. I have her go on the computer. She probably has no idea what we're doing, but I'm like, okay, click here, click here. I just want to get the muscle memory build of like when you get money, invest it, and you get that long-term growth. That's what the idea is. Again, this is The Real Money Pros. We've got to take a break. We'll be right back. We are live here for you. Phone lines are open, 979-59-MONEY, 979-596-6639. You have questions about your financial life, you can call us. You can send us a text message with your question. We are fiduciary financial advisors. We feel pretty well versed so we can cover any topic. You're going to sell a business, you're planning to retire, you're in retirement, you want to talk about Roth conversions, you want to talk about proper tax withholding, you want to talk about restricted stocks units, you want to talk about proper estate planning, you're running into a taxable estate. These are all things that we've seen.
We talk about all the time.
And we've seen this in real life with clients and worked through these various strategies. I mean, pretty much all these probably multiple times between the two of us throughout the year. And obviously multiply that even more when you look back years. And yeah, you get the point, right? We're not here to sell. We're here to guide. Bottom line is we love to talk through topics that can seem complicated or they might seem just...
Sometimes it's just, how does it actually fit for me? Because I know it applies, but I don't know how to put it into the picture.
Oh, case in point, I met with some great clients earlier this week, prospective clients, and they just sold a business this year. They wanted to sell it last year, and the whole business sale was just exhausting to them, just an emotional drain. So now that a part of the business they have it structured to where they get a payout over 6 years, and then he wants to start another business potentially, but he also was under a lot of stress and was worried about the health problems. And then his wife wants to retire in 4 years, but she's up to a rule where she might have to work a few more years to maximize her pension because she's a state employee. And they've been deferring money into these various investment accounts, and they're approaching Social Security age and this and that. There's probably like a number of other things like, should we pay out the house? Should we not? Like that was just a quick snapshot, right?
Right.
And the real question becomes like, how do all of these work together so we understand the plan and make sure how each one complements the other? So we don't have to worry about it. Like we know the plan. Like we create a plan. We know the plan's good. We understand the plan. And maybe it's a plan A, plan B, plan C that you look at. And then you understand all of them and you stick to the one that you know that you feel that you have the most conviction behind. Right. And you have the discipline to follow. And ultimately you have someone guiding you that is experienced in this that can help you make these decisions.
And someplace when you get down the path a little further and there's either a big financial decision that comes up or just some time has passed, you want to make sure you're still on the right path. A financial planning situation, a one-time thing's great, but it isn't enough because down the road, your life is different. Inflation, health, spending, the things that you have for goals, all of those things have the potential to change, and that may change your direction. It may be a minor tweak, it may be a big one, but remember to come back and re-look at the picture and the puzzle pieces that have gotten moved around, put them back into place.
And then it comes down to the numbers too. So then you can, like I'm a big spreadsheet guy. Like spreadsheets kind of give me peace. Like even things that have like no business
they're
being
in
kind
their place.
Like being structured in a spreadsheet. I'm like, I'm going to do it anyways because it's just how my brain operates. And I think, and that isn't the case with other individuals. But in my opinion, it's like, you almost get that spreadsheet outlook, like that organization of like where all these things go. And at the end of the day, they're numbers. Like when you're talking about Social Security, pension, taxes, it's like, but you got to understand how the rules work within these, especially from the tax side of things and health insurance items and all of that, to make sure that you arrive at your desired outcome. And that desired outcome is usually in the form of some type of annual spending. But that annual spending is also going to be in the form of quality of life impact. Where it's like a trip, a cruise, spending time with family, gifting money. And it's funny, I had an interesting meeting with a client. I was like, the numbers look really good. I'm like, well, you need to put some more thought into like what you want this money to do for you. Like not from an investment standpoint, but it's like, because the question is, what should we do with them? Like, we need to define like how you want to do this.
Right. Well, and there's people have different priorities and there's lots of options. So whether it's they need to spend more during their retirement because they're really underspending, they've had a large windfall from restricted stock or the sale of a business or something, an inheritance. What do you want to do? Do you need to stock up your emergency saving? Do you want to pay for your kids' college? Do you want to pay off your house? What do you want this, like you said, to do for you? Charitable giving. I mean, there's some things you can do that way that can be really easy and really beneficial if that's how you are thinking. But if you're not looking to give money away, those don't make any sense for you. You know?
So get creative about spending.
Yeah.
All right. We're going to go to the text lines. Again, you can send us a text message or give us a call, 979-59-MONEY. That's 979-596-6639. I'm going to summarize this question. A large portion of my net worth is tied up in company stock from RSUs and stock purchase plans. Does it make sense to diversify? The problem is selling is likely going to trigger a significant tax bill.
Yeah. So I will say that I struggle when somebody's primary net worth, their paycheck, both come from the same place. Because that is a lot of concentration of, and it's called concentration risk for a reason. But it's
your
a lot of
your eggs are one basket.
One basket, and that's a lot. But I also understand that this selling and the tax bill and all those things come together. There are ways to get that diversified and mitigate the tax rate. Not so much with options, but with vested restricted stock, which is now just stock you own. There are options and things that can be done to ease out of it gradually over time to minimize the tax, whether it's that you personally sell out over time or we use other strategies. If you have time on your side and enough, there are ways to come out with a net zero taxation and end up fully diversified.
So give an example of that. I mean, because I think people hear that and it's like, well, what does that actually mean? Because they'll see, because generally what will happen in this case, it's like, especially in this text question, I would imagine that they look at their statement in which they hold these stocks and they're going to see the unrealized gain.
Right, which is what's going to get taxed.
Which means if you sell that position, that unrealized gain number is what's going to be booked as a capital gain. And then how much taxes you pay on that capital gain is going to be, it's going to be dependent on a number of different things. What's your overall income? What capital gains rate are you in? Is it long-term, short-term? It's probably going to be long-term. Is there net investment income tax? Is there other tax ramifications if you sold that that's going to increase your adjusted gross income? You get the point. But I would imagine that's one of the big deals where it's like, and they're probably listening, and obviously he's asking the question because he's like, I see that I'm overly concentrated, perhaps. Like all of my net worth, or a big portion of it, is tied up into this single position from this company, making me feel a little bit nervous, which is completely justified. But if I sell it, then a lot of these gains that I'm going to recognize is going to just be sent to federal and state tax. Yeah. So how do you what strategies are out there?
So the one where you can kind of come out with net no tax is it's a long short option where they put options on either side of your stock and sell whatever's at a loss to offset the gain of the actual stock as you go. In my opinion, things that are going to stay consistently valued, that you're not worried are suddenly going to be, it went from $400 a share to $30 are the best candidates for these.
Like meaning you're bullish on it long term.
Yeah.
Like meaning you're
exactly. That's the word.
Instead of being land rich, cash poor, you're like highly concentrated stock rich and cash poor. So it's like, hey, this is great. I have a gain on paper, but like that doesn't translate into quality of life. So I need to sell that to go buy the mountain cabin. I need to sell that to go buy the boat. I need to sell that to fund college tuition. But then you run into the tax side of things. So I get it. It's like you still like it. You still like the position. You're bullish on it long term. And obviously there's probably a good justification for that. But now you're talking about tax efficiency. So that long short strategy certainly is one of them, where you're executing an investment strategy that's using derivatives, using options, that's essentially doing tax triage, where you're basically netting zero and you can still get that liquidity. You could do a supplementation of maybe a direct indexing strategy where you're still getting market-like performance, but you're harvesting losses throughout the way. If you're charitable minded, you could look through different charitable items. You can maybe move some of that stock into some type of irrevocable trust that has more legacy benefit to it, but maybe you can live off of that income. And that's just scratching the surface of strategies that you can look at. So to answer your question directly, how do you evaluate whether it makes sense? You meet with a fiduciary financial advisor who is well-versed in this arena, who can help guide you to the right decision, the right strategy, and then they help you execute that strategy. That's what it's about. Happy weekend to you. This is The Real Money Pros. This is hour number 3 of our 3-hour live program. Live meaning you can interact with us. I'm Jeremiah Bates. She is Alexandra Lundgren. We are fiduciary financial advisors. This is a financial show. We are not here to sell you anything. We're not here to sensationalize headlines or invoke any type of fear what's happening in the markets, even though it's at all-time highs. Jeremiah, we're due for a correction. Maybe, maybe not. You know?
We've always got all-time highs coming someplace.
Just keep buying, right? But again, any topics that you have top of mind in your financial sphere, fair game. Give us a call, send us a text message, send us an email. Phone lines are open, 979-59-MONEY. That is 979-596-6639. Email at jeremiah@therealmoneypros.com. Alex, ALEX, at therealmoneypros.com. If you give us the nod, we will answer your question on air. We've had some text messages come through the past 2 hours that I think they're important to kind of cover again, because we're covering kind of an array of things, right? One of which is tying to financial planning tools, like meaning what people have at their disposal when they're, especially in retirement, or trying to forecast the success of their overall financial plan. There's various financial planning tools out there that advisors will lean on, that individuals will lean on, and maybe it's through your 401k provider at work, or maybe your investment dashboard, and it shows you some metric of feeling good, it's like a gas tank gauge. It's like a sad face and like a mild face and like a really happy face, right? Or maybe it's like a percentage of 20%, 50%, 95%, or it's like a gas gauge of, red is bad, and then you start to get to like orange, yellow is getting better, then eventually you get to green, and it's like, great, I can retire without running out of money. Because really, for the most part, paint with broad brushstrokes here, when you're looking at this probability of success with retirement, leaning on what is called a Monte Carlo simulation, and that's usually the formula that is used behind the scenes of that little graph that you're looking at. So whether you've met with your advisor and they're showing you this graph, right, and like, hey, things look great. Like, okay, great. It's like, I can go spend money, right? Or I'm not going to run out of money.
But how much can I spend?
But or you see it and it's not working. Like maybe it shows only 50% of success. Or there's
okay?
There's the sad face on your projection. We got to dive into the nuances of these so that you understand what it actually means. Because if you see a good number, we got to understand how it's arriving at that. And also if you're seeing a potential failure of you hitting the mark on your retirement plan. Because these Monte Carlo simulations, it's a simulation. What it's going to do, go back to statistics class, standard deviation, first deviation, second deviation, all of that, right? So what it's going to do is going to take 1,000 different market trials, going back in time. And within those 1,000 different trials, we know that it's gonna run assumptions on good market years, bad market years, average market years. Sometimes those bad market years are going to happen the day that you retire, the first year, or maybe there's really good market years for the first 5 years retire. And then ultimately you're going to arrive at this probability of success, if you can even call it that, by the way.
For sure.
But it's also what it's going to run those assumptions on is your inputs. Like, let's imagine you have a 401k, a Roth IRA, a traditional IRA, and if it's in cash, let's imagine those accounts are not invested at all, and you run that Monte Carlo simulation, then it's just going to be, did you save enough in cash to sustain your withdrawal rate every year, accounting for inflation?
Right.
And sometimes that number is going to be good, sometimes that number is going to be bad. Who knows? I think it's a rare bird if someone's in those positions, has those accounts is completely cash. But proving my point for illustrative purposes, that if you looked at that, you're not going to see a big difference between the upper 80th percentile of market performance or the bottom 20th percentile of market performance or the 50th percentile, which is your average market years. Why? Because your accounts are invested. Like it's not subject
it's
to
stable.
Yeah, it's stable. It's not subject to market volatility. So again, that just proves the point. Like what's going to drive the output of these metrics or these gauges, or AKA Monte Carlo, is it's going to be based on your input, and it's a point in time. So like Alex, if you met with a client and they have, the husband has a 401k, the spouse has a 401k, they're both putting money in the Roth IRAs, they have a non-qualified account, just means that it's an investment account, not in the form of a IRA or a Roth or anything. And they're invested, maybe it's they got some growth investments, they have some conservative investments, maybe it's a mixture, like what you'd call a balanced portfolio, and you run the Monte Carlo simulation. That's going to be based on that point in time. Like what are you putting in there?
Right. What are you starting with?
And it's also going to be under the assumption of what your spending rate is. Like what are you going to decumulate out of your assets? So in this Monte Carlo simulation, it would behoove whoever's there, like whether it's your advisor or you're running this tool on your own, that they're accounting for, do you have a pension? When and how are you filing Social Security?
Yeah.
When are you going to retire? And most importantly, what your expiration dates are. Like how long does your money need to last you? Because I think you would be surprised, and Alex, I'd like to get your thoughts that, if we're projecting someone to live till 95, who knows if they're going to get there? We don't have the crystal ball. But let's imagine they hit 95 and we see a failure. It's like, 40% success rate. I'm like, well, that's not good. What do you mean I can't retire? It's like, okay, let's look behind the details a little bit. It's like, well, actually, the plan starts to come under the plan comes under pressure, your probability or degree of success per this tool that we're using, it just comes under pressure when you hit 90, which means you're good to fund this till 90, but those last 5 years, again, assuming that you're spending that same amount.
Right, which is not what happens.
And there you go. There is that disconnect between that technology, that tool, that Monte Carlo simulation. There's a disconnect. There's a disconnect from the reality of the person that it is supposed to apply to.
Right.
And that's it.
Yeah, because spending goes down drastically after the first few years of retirement. I think the first 3 to 5 years is like the most people usually spend during retirement. They either purchase things that they're going to utilize, such as a camper or a swimming pool or whatever it is, or they now have time to do all the things they haven't been doing, as the travel, or they do a huge landscaping project or whatever it is. But it seems without fail, the first 3 to 5 years, they spend a lot more than they do the next 10.
Yeah, maybe you want to buy some horses. I have a client who did that.
Yeah.
It's funny, in the years of working with them up into retirement, the conversation of horses never came up. And about 2 years into retirement, like, we want to buy some horses. I'm like, great, let's figure it out, right?
Right. Yeah. And it's not a success rate. What it is how likely are you to have to maybe make a change in what you're doing during that time frame, whether it's rein it back a little, or maybe you don't buy the car in the exact year we put in the computer. You buy it the next year or the year before, depending on market conditions.
I like that. It's not a prediction. It's a stress test based on the inputs that we put in that at that point in time. Okay, so we're not just going to sit here and say that this is a worthless endeavor, right?
No, it's not at all. It gives you a good starting place.
It does. And I think the one thing that you certainly got to give it a nod to is that it represents there is market volatility. There are up years and down years.
It's way better than just saying you're going to earn the same percent every year for the rest of your life.
Which makes sense, because this is a common thought. And some people go really aggressive, in my opinion, of, well, the annualized performance of the United States stock market over the past this many years has been 9% or 10%. It's like, yeah, okay, like you don't want your retirement success to be based on that assumption that we're going to see the linear year-over-year growth of 10%. Like, so right. The Monte Carlo does give that great illustration around there's market volatility, and there's going to be some years where you could be in a down market, say 20%, 50%, 13%. Maybe it's a flat market, and maybe there's some good years with it. It reflects that there's market volatility, and that also is helpful to understand what's called that sequence of returns risk. And that's just a fancy way to say that you retire, And if you haven't solved for the proper liquidity of your investment picture, meaning a percentage of your assets that if we see a deep bear market, it's not going to get drawn down. But that sequence of returns risk really runs you into is that if you retire and you see a deep bear market, like day one, year one, it can change things dramatically compared to the forecast that you had. Yeah. And that's the one thing that you could take away with that Monte Carlo. But again,
you can plan for that.
You can plan for that. So sequence of returns risk, it's that proper management between liquidity, growth, and if you need income off of your investments to sustain cash flow, that's what it's there for. So again, these tools are there. They have a purpose.
Not the be all end all.
Yeah. And looking at it in a vacuum on its own, on an island on its own, there could be some pitfalls to that. The whole picture, the tax side of things, the nuance, the human emotion behavior, just as important. We'll be right back. Money Pros, again, we are live if you're listening, which means you can interact with us. There's a lot of good financial shows out there over the weekend. I will be honest. Not saying, well, what makes us different is that we're live and you can interact with us. You have questions, call us. You have questions, you can text message us. You have questions, you can email us. Phone lines are open, 979-59-MONEY. That is 979-596-6639. Jeremiah, yes, all 4 syllables, kept the full name, right? Jeremiah at therealmoneypros.com, Alex, ALEX, at therealmoneypros.com. If you give us the nod to answer your question or present your question on air, would love to do it. Like I said, text lines are open as well. I want to get into the text lines right now. We did have a message coming through in regards to really what we were talking about. I'll paraphrase it. 63, planning to retire, working with an advisor. They show me Monte Carlo analysis. It shows a good success rate. What is actually driving that number? And if some of the inputs change, does that impact the result?
Good question.
Great question. Well, the assumptions are there's a lot of assumptions built in there. Like we talked about the kind of the numbers behind the Monte Carlo simulation of how it runs those different scenarios, but also what assumptions are going into are like, that's what you input, what you and your advisor should have a good conversation, and it should be capturing everything. Like, what are the inputs and the resources that you have? So what are your income inputs? Social Security, pension, rental properties. Like, are you going to have passive business income? Do you have, maybe you're have a client's part of an irrevocable trust and they're maintaining, him and his family have maintained that single family rental property in California for a number of years. They don't plan on selling it. So every year that kicks out a distribution that they pay tax. Like, that needs to be taken into consideration into that Monte Carlo situation. And then also your assets, your cash. Do you have cash value in insurance policies? Do you have an annuity, your investments, your Roths, your traditional IRAs? All of that. Like those are the things, those are the assumptions that are going to be in there. Your age, when you want to retire, how long you're going to live, what is inflation looking like? Like what, and also big one, what are your expenses?
Yeah,
like
right.
So
like
now,
non-negotiable expenses.
Like what are we taking? Like what are your outputs now, and what's going to be done on an annualized basis, and what expenses maybe are not going to happen year over year, but I'm gotta replace a car eventually. It's like, okay, you want to put that in there most likely, or is there a wedding, or you got to pay for college? Like meaning it's kind of like this piece here, right? Those are things that are going to be built in the assumptions on top, and then you have the scenario analysis based on that. So then the question of, if I change a couple variables, will it affect the result? Absolutely. What's the projected growth rate on your investments? Is it too conservative? Is it too aggressive? Does it have realistic representation of your investment snapshot now? And does it take into account that might change? Because if you're going to retire in the next few years, maybe you're still tilted more towards growth, like meaning you're not really tapering down the growth exposure, the risk, right?
Yeah.
Those are all assumptions that are taken in there. So if you make adjustments to it, that'll likely change the result for better or for worse.
Right.
Like meaning if the margins are already thin and then you increase spending, that'll change. Or if you change your expiration date, that's likely going to change too, because now you just took off maybe 5 to 10 years of funding that the scenario had to account for. So it's a good question. Again, phone lines are open, 979-59-MONEY. It's 979-596-6639. We're going to go to the phones right now. We have Adam calling out of Illinois. Adam, what can we do for you?
Yes, sir. I am retired. I have $100,000 in cash that I've been using in bank CDs. Interest rates in the bank CDs over the last 5 years has dropped to where it's around 1%. Mm-hmm. Where else can I put this $100,000 and not lose it?
Well, Adam, I think number one, thanks for the call, and you're absolutely right. We've been seeing the deposit rates, especially at your brick and mortar banks, they've been on a decline. I mean, that's just the reality. I mean, when we were looking at, I think at one point you could get over 6%, like probably like over 6% when obviously inflation was high.
You want to know how old I am? I remember doing CDs at 12 and 14%.
Okay,
so now you just know how old I am.
But on the flip side of that, interest rates are high, right?
That was a while ago.
So Adam, you're in a spot where, yeah, I want to maintain liquidity, and you nail it, because my follow-up question to you is going to be, what's the purpose of the money? And if the objective here is to maintain that principal protection, it's like, I want the cash at arm's length, not subject to any market volatility, but knowing that the bank is paying 1%, are there better options out there? Yeah.
My first suggestion would ask your bank if they have a high yield savings account, because some of those pay more than the CDs right now. Now, the caveat is that you don't get that guaranteed amount for the amount of time that you lock up. Like in a CD, if you get 2%, you get it the entire time that it's in that CD, because you've agreed to that with the bank. So the high yield can fluctuate, but a lot of those are paying actually better than CDs at the moment. But it's also because they can pull it back really fast if they want to.
Here's a caveat that I have learned over the last 5 years of having CDs. If you don't get a 1-year CD, you actually earn less than what the interest rate is for the year, because the industry standard is referred to interest rate per year.
Yes.
Right now, they'll give me 4%, but for 1 month, which means I'm only going to get 0.3% interest.
Right.
So it's very misleading.
Adam,
You are absolutely correct.
I'm so glad you brought that up, because you're absolutely right. That APY, and the key thing is annual. So you're right. If you get in a 6-month CD where the annual percentage rate is stated, let's say 5%, but you're only in it for
4%?
6 months, you're getting 2.5.
Yeah. Good. I'm glad some people don't understand that very well. So good job.
No, and Adam, I would say that,
and
go ahead.
Something else that people need to be aware of, that if you buy a CD and you allow it to roll over, the rollover they're talking about is the time period.
Correct.
I had $30,000 in a CD. They rolled it over, and it rolled over to 0.1% for 3 years before I noticed it.
Ouch.
Yes. I lost $1,000 a year by not paying attention. Well, there's no education for you.
Agreed.
And that's why I'm calling to try and educate people to be aware that the best thing I found to do is to get a 6-month CD or a 1-year CD, and every 6 months they mature.
Yeah,
go in, get a new CD, so the interest rate is in writing.
There you go.
Yeah, and Adam, what you're referring to, you can look at it as like bond laddering or CD laddering, where you have various maturity dates. There's pros and cons about doing short-term versus long-term, because the longer term you do, the longer duration of that CD, where you're insulated from a potential interest rate drop. So then if it was at 6 months and we see a dramatic drop in interest rates, especially from the banks, well, then when you renew that next 6 months, you're losing on it. But if you did a 2-year CD, well, then you're getting that favorable higher interest rate for that full 2 years. So there's pros and cons of it. The downside of that is, I'm using air quotes here, you're locking your money up for a longer duration. But that's kind of the idea. The longer term of the CD, hopefully you get that better return. But Adam, certainly appreciate the call. We're up against a break. But, is there better options? Yeah, you could look at money markets through Schwab, Fidelity. I'm looking online right now. E-Trade has a savings account that's paying close to 4%, but that's only for 6 months. SoFi Bank is 3.8%, so you can find better interest rates on your cash out there. You just got to look. We got to take a break. We'll be right back. We are back. This is the Real Money Pros. We are live. So we're a 3-hour program. So 3 hours of broadcasting, some markets pick us up for the first hour. Some markets pick us up for 2 hours. I don't know of any markets that are picking us up for the full 3. So it's kind of a bit of a mix. And then I do know that, there could be some other programming particular that might catch us in. But just so you know, we're 3-hour live program. If you've missed any of the previous hours or any previous week's shows, go to therealmoneypros.com. So that's where you can pick up our educational content. It's where you can pick up our previous podcast shows. So if you caught something, you're like, wait, I didn't quite catch that. Well, I would say call us again, 979-59-MONEY. That phone number is 979-596-6639. You can send us a text message. So you can text us during the week. You can send us emails, Jeremiah@therealmoneypros.com, Alex@therealmoneypros.com. So if something sparked your curiosity or you have a legitimate question of your specific situation, hey, we're accessible. That's one of the things that we want to make it clear out here is that there's no barriers to get a hold of us. So please do. But again, therealmoneypros.com, it's there. We're a sponsor-driven program. We're not here to sell you anything. And the bottom line is this, we're covering, we go through topics every Saturday. And even when we do our posts during the week, we're covering various topics. And these topics generally, we roundtable in our office between the advisors. And these generally come out of conversations that are common through clients that we're all meeting with. And we're like, wow, if we're all hearing this, and this is kind of across the board here in our office, this is a good topic to cover on and just put out there through our various channels to help provide some better education out there. But the reality is that going through these topics, it's pretty clear that good financial decisions do not happen by accident. Even though I do love the line of I'd rather be lucky than skilled any day, right? But they don't happen by accident, generally speaking. So if you're navigating retirement, or approaching retirement, you're concerned about taxes, business decisions, you're looking to sell your business and you want to know actually how to properly structure it, or maybe you're a few years out and you just don't know how to unwind it, or you just want more clarity around all the moving parts of your financial picture and how it is going to dictate the future for you, your family, and your kids, having the right guidance matters. So bottom line, that's what we're here to do, give you guidance, and we have a team of advisors across the country that are in your corner, fiduciary advisors that can give you the guidance that you want and that you need. Visit therealmoneypros.com, click on the Find an Advisor tab, and we will get you connected with an Apollon Wealth Management advisor who is a good fit for you and your situation. Okay, so Alex, we're talking about Monte Carlo situations, how we're using that as a financial planning tool, but
these percentages of success.
But also how that performance metric can be misleading to an extent.
Absolutely.
And go ahead.
Well, so I've shared this with you in the past. I had someone I was meeting with, and they said, well, the last person, because I was like, oh, you guys are in a great spot, right? I mean, they were at a 90%. I'm like, if you want to retire today, go for it. If you don't, that's fine. But they said, well, the last person told us that we wouldn't get on a plane that only had a 90% success rate of getting to its destination. Oh, well, here's the thing.
That's a complete misrepresentation of what that Monte Carlo or what that result is actually saying.
That actually feels a little manipulative to me, but it's a way to generate some emotions for a person, and we can do that to ourselves, right? That would generate an emotion of fear, but it's really easy as a person looking at your numbers to do it just to yourself. Nobody has to make that comment. You can be like, oof, 90% is not close enough. I actually had a client who wanted to get 100, and I had to explain to him it was impossible because the lawyers would not let 100 come up. But oftentimes, you don't need it to be huge. You just need it to be where you're comfortable taking the start and willing to adjust as need be to keep it successful.
Yeah, I think the follow-up to that would be, okay, if you see that 90%, or if it's even 50%, and it's just like red, and you're like, oh, that's just, I can't retire. It's like,
I'm never going to get there.
It's very helpful to ask the follow-up question or have the understanding of, how is this Monte Carlo or this little gauge or this little whatever it is, how is it arriving at that? Like, how is it getting that number?
Right.
And then once you understand that, then you know what that number actually means to you. So
Well,
it completely
and
it completely changes the dynamic of like, oh, it's in the green, great, I got nothing to worry about. Or it's in the red and like my financial future's completely kaplunked. There's much more nuance to it.
Well, for example, in 2021, I had clients who they were thrilled with their numbers. They felt totally on track. They came in the last half of 22 after that down cycle, and we're like, we just got set back 10 years. Well, they didn't. We were just in a down market right then. Had they been actually in retirement and we had the cash flow set aside, it would have been fairly unimpactful. It's that period in time. So the balances were different.
Well, and then also too, with the Monte Carlo, making sure how is it connected to your cash flow plan and your distribution plan. Case in point, I was showing a client this and they're really trying to get granular asking that question. Well, like, how are we arriving at that? And, I was explaining to him, hey, you got to take this with a grain of salt to an extent, but this does just help represent that there is volatility and there will be market volatility based on how you're invested throughout the duration of your retirement until you pass away. That's just that is one of the takeaways you can get from the Monte Carlo. But if we look behind the scenes of the actual ledger, if you will, of how it's all being represented based on the Monte Carlo, it was showing that an account that we had earmarked for long-term, like honestly, it probably would have been gifted to their kids. Like they probably won't even touch it. It reflected that there was going to be and this was default. We can kind of customize things, but this was just like a jumping off point to a point. But it was showing that in year 2 of their retirement, that account that it showed a big drop in that year. Cause again, it's throwing different market assumptions on there. So it showed a big drop on that account. I think it was down 13%. And then it showed a large distribution out of that to fund their cash flow. I'm like,
which would never happen in real life.
Which is not how we actually built the cash flow and distribution plan. So bottom line is this. If you're looking at these tools, if it's in the form of this gauge of Monte Carlo, it does serve a purpose, but understand what purpose it is serving. You understand it. So whether you're the one doing it, you're looking at it, putting in the inputs, or if you're working with an advisor behind it, that there's analysis above and beyond that, where it's not just Monte Carlo says we're good, so we're good. I'd take pause to that and just do a little bit deeper dive. Again, phone lines are open. Text line is open, 979-59-MONEY. That is 979-596-6639. Let's pivot from the Monte Carlo. One thing that we've seen, the market's all-time highs. All right,
yeah,
this thing just keeps going up and to the right. So if you're interested in talking about that, happy to do it. But one of the side effects is that we've seen, and we've seen it directly, Alex, with a lot of clients that we work with, and there's a lot of people across the country of how they're receiving compensation, and in the form of actual stock from their employer. And there's some notable companies out there where, hey, if you're right place, right time, again,
you could have a windfall.
You could have a tremendous windfall where if you were looking at your income on its own, it's like, well, I got some work to do. But just through the sheer growth of that company's stock that you were awarded, and this could be done in a lot of different ways, shapes, or forms. But whether like maybe it's restricted stock units. So you work with an employer, they give you restricted stock units, and they could be seeing tremendous gains from these restricted stock units that were awarded to them by your employer. What does it mean, and what are things that need to be paid attention to, and how can you be strategic about this if you are, like maybe if you're in the technology space and the company is in the AI field or it's a part of this AI narrative, I'm just throwing it out there, and you've seen this stock just be on fire over the past couple years. And you're looking at your net worth maybe a few years ago, and now you're seeing it now. You're like, whoa, like you've just entered in a level of a higher, like a degree of sophistication that arguably maybe wasn't even on your radar a few years ago.
Right.
It should be.
Absolutely.
And which is a great thing to have. It's not about what you have, it's about what you keep. Because with these RSUs or these highly appreciated stocks that you could potentially be getting from your employer, it comes with tax ramifications. So I think it's important, Alex, like to cover what these restricted stock units actually mean to an individual. Like what's the terminology? What are the things that you got to focus on?
So What it means is that they were gifted to you with the idea that you had to continue to work there longer to receive them.
So it's kind of like golden handcuffs.
Yeah.
It's like, hey, you work with us, we're going to pay you your wages, right? But you're going to get awarded these stocks, this company stock.
That hopefully will be worth more at that point, right? And so it's a matter of when are they available? How much do you pay for them when you get, or how much are they valued at when you get them? Because taxes at that point, when it vests, you got a tax bill.
So this is an important thing to look at the timeline, especially with these restricted stock units, because you'll have a date in which you're awarded. Really no taxable consequence at that point. But remember, the stock is in the form of compensation, right?
Yep.
So when it vests, and they could have different vesting schedules, but when that stock actually vests, which means now it's in your control. If it's not vested yet, you can't do anything with it. It vests, you now have that stock. You can gift it, you can sell it, you can do whatever. But the year that it vests,
Tax bill.
ordinary income. It's going to get through your W-2. So be prepared for that. And then if you want to sell it, be cognizant of that, because you could be running into short-term or long-term capital gains, meaning you got to be very mindful of how you cover this from a tax standpoint. We're going to cover that when we come back. Welcome back to The Real Money Pros. Again, therealmoneypros.com is where you can find us. Phone lines are open. We are live, 979-59-MONEY. That is 979-596-6639. You can send us a text message. You can email us. We are here for you. You want to change the topic? You have questions? Anything is on the table when it comes to your financial questions. You can test us. I feel like we're pretty well versed in like all these arenas. And if we don't have an answer, we'll make sure we get it for you. We're talking about compensation through companies in the form of stock. Meaning if you're I wouldn't say fortunate enough, but hey, again, if you're fortunate enough to work for a company that a part of their compensation package is, let's say, restricted stock units, and you've seen a dramatic increase in those stock prices, it's great. What's the strategy behind it? How are you going to cover the tax bogey? How are you going to cover the liquidation of it? How are you going to be prepared based on the action that you're going to take? And one thing that we were talking about in the last segment, Alex, is the terminology around this. So obviously we're talking about restricted stock units. Restricted meaning that
you can't do anything with it.
You can't do anything with it until you hit what's called a vesting date. And those vesting dates are going to be based on a schedule. You will know that. There'll be a vesting schedule as soon as you are awarded these stocks. And then I guess the next logical question is, well, why would there be a vesting schedule on it? Well, because they don't want you to hire on and then work there for a month, get all this company stock, and then turn around and leave, go work for, so there's a little bit of golden handcuffs in there to say, hey, you gotta pay your dues to be able to actually reap this benefit, if you will. So you get awarded the stock, it'll be tied to a vesting schedule, and then when it actually vests, the year that it vests is when the rubber hits the road of understanding how this thing is going to impact you from a tax standpoint. Right.
And then when it vests, whatever the value of it is your taxable amount as income.
As income. Because remember, it's a form of compensation.
Right. Then it's now yours. It's no longer restricted. It's just stock. So you can choose to sell it right then. You can choose to hang on to it. You can choose to direct gift it into a donor advised fund. You have a lot of available options to you of what to do with this stock. Depending on the amount, you may have more because there are some things that it just takes more to be able to access. But it's now up to you to decide when you want to sell it. And that will affect the taxes as well. If you hold it for less than a year, it will be short-term gains, which is the same as income. And if you hold it for a year or longer, it'll be long-term. Unless it goes down, and then you could have some losses you book if you want, or you just keep hanging on to it and wait for it to come back.
And this is important because you could imagine a scenario where stock vests that year. You're like, great, I finally the stock's been on a tear. I'm going to go buy that boat. Like, I got the money to do it, clearly, and I'll still have some money left over in the stock. So, yeah, let's sell it. So then you sell it. Yeah. So now let's fast forward to tax filing time for the year that you sold it, and you're getting all your tax docs in the mail and all that. And all of a sudden, you're getting, in the form of compensation, you're getting the value of that stock that it vested, the number of shares. That's going to be taxed as ordinary income. So did you change your withholding schedule from your pay, your W-2 pay? Because if you didn't,
you probably under-withheld.
You probably under-withheld, which means not only are you going to have a big surprise just of like, I'm usually used to getting a little bit of a return, like money back, or maybe I owe a little bit, but this year I owe a lot. And that could just be just from the stock vesting, like meaning just
without even selling.
You didn't do anything. It just vested. And now all of a sudden you have a tax consequence. And now in this scenario, let's add on the fact that you sold it. And depending on when you sold it,
you might have some additional gain.
Which hopefully that you're
income.
prepared for. So again, you got the benefit of it. So don't let the taxation of it catch you off guard or take away from the liquidity, because then you could run into another issue where even if you were forecasting this and understand that just it vesting, it's like, oh, I need the money, and then you sold stock just to cover the liquidity, you could have this compounding tax effect because you might be paying capital gains on that. And then depending on how much you sold, you could be running into the net investment income tax on top of that, and that gain on its own will increase your adjusted gross income, your MAGI income, which could cause effect to a bunch of other items. So what it really comes down to is having a proper plan in place to understand the financial decision that you're making.
Yeah.
And it could be the right decision where it's like, yeah, you sold it, and then we'll just forecast the tax side of thing. Maybe we start making some estimated payments, or maybe we increase your withholding, whatever the case is, or maybe you're charitable minded. Hey, instead of using the cash out of your bank account to do your charitable donations, why don't you just gift the stock? It's like, I can do that? Yeah, absolutely. What if you set up a donor advised fund where you can move the stock into the donor advised fund, and then then the stock is sold. Now you have cash inside that donor advised fund.
And you don't realize the gain.
You didn't realize the gain. And by the way, the contribution to the donor advised fund, it'll help you from a tax standpoint because it acts as a charitable contribution. So then you look at, okay, is this a year that I should probably itemize because I have some other items, or this is a big tax year? So let's do a large contribution via the stock into my donor advised fund, and then that could be the vehicle that I use moving forward for my charitable endeavors. These are all valid strategies. I mean, let's imagine you're in a situation where a lot of your wealth, and Alex, you and I have seen this, where just over the past few years, a majority of your net worth is now tied into this single stock.
Which oftentimes is also the company you work for.
Which a lot of times is the company that you work for.
That's a lot of risk in one company.
So then again, what you could run into is the taxable hit, where you have a hesitancy. It's like, I know my eggs are in this one basket, but if I'm still bullish on this stock long term, so I'd still like to hold on to some of it. But I know if I start to unwind it, a huge amount's going to go to taxes. What do I do? There's a lot of things that you can do. You just got to see what's available. I mean, you could look at irrevocable trusts, where you could do charitable remainder trusts, where you could route the stock into there where that holds, so then you're not getting the tax consequence, and you can actually take income distributions off of that. You could do the gifting strategy that we talked about. You could do, if you have other tax loss harvesting that you could do on top of that to help offset the gains. You could do a long short strategy where on that position that you own, there's derivative strategy where you're doing long and short options that are tax efficient, where potentially you could net zero on the liquidation of that stock, meaning no taxes. So there are a lot of strategies out there that are at your disposal if you are in that situation. But first and foremost is understanding the logistics and how these restricted stocks operate. And that's just not the only shape and form that getting stocks from your employer is. Like, it's not always in the form of restricted stocks units. You can have just standalone stock options. You can have ISUs, like NSU, like NSOs, right? Like ISO, like the list goes on. An employer stock, an ESPP, employer stock purchase plan.
Right.
But the real question is, like, how do I approach these? Like, are these available to you? Making sure that you have a strategy around it, because you just don't want to be. You
don't want to be surprised with a bill at tax time. Period.
It's that cliche that paying more in taxes is arguably a good problem to have, but it's always looked at as a problem. And you could also look at this through Roth conversions, by the way.
For sure.
I mean, if you're not accounting for that taxable income that you would receive from a Roth conversion, yeah, it's great that you're being mindful of strategically recognizing income into a Roth, so you get that growth inside the Roth, and then on distribution, it could potentially be completely tax-free. It's great, and you could also lower requirement of distributions, more efficient inheritance. Like in the T-chart of decision-making, a lot of pros on that.
For sure.
But also understanding that if you do, let's say, a $100,000 Roth conversion, that's $100,000 of income that's going to hit your tax return.
Right.
So how are you accounting for that extra income?
Gotta pay that bill.
And do you have other sources, other liquidity? Do you have to let that through withholding? If you're pre 59.5, probably don't want to take that route because you'll be earmarked as an early withdrawal penalty. So there's some moving parts to this.
Yeah.
And the right strategy that hopefully that you're guided to make by an expert, a good quality fiduciary advisor who's familiar with these, in my opinion, it's worth its weight in gold. We talked about this a couple of weeks ago on the show, Alex. It's like, what's the cost of not working with an advisor?
Yeah.
And I've seen it a handful of times where I've met with people, and it's like, if we just could have met last calendar year. And I'm hesitant to say because it's like rubbing salt in the wound. It's like, okay, let's move forward. Like we can still look at some good strategies, but that's largely in the formula. And I'm in this boat too with a lot of things. Like, you don't know what you don't know.
For sure.
So
but it can hurt you.
It can hurt you. And we don't want to get hurt. We want to feel good. We want to feel good about the money. We want to have a good strategy. Make sure you educate on it so you know how all these parts work together. So whatever your desired outcome is, you got a solid strategy to get you there. Again, good financial decisions don't happen by accident. Navigating retirement, taxes, all these items, the right guidance matters. Visit therealmoneypros.com, click the Finding the Advisor tab, and we'll connect you with a fiduciary advisor with Apollon Wealth Management. Have a great weekend.